Welcome, everyone. I am Jim Bell, President and founder of Bell Investment Advisors. I'm here with Corinne Solera, key person on our investment committee and portfolio manager, investment advisor. So I'm very happy to be doing this presentation with you, Corinne.
Thank you, Jim. Happy to be here on a rather historic day.
Indeed. So this is our preview of next year, 2016, and a wrap up of where we are now in 2015. If you have questions, please submit those in your question box as we go. Corinne and I rehearsed this yesterday, and it ran just over 30 minutes, so that's what we like to keep it to. So if we don't get to your questions live today, we will make sure that someone gets back to you to answer your questions. But we do encourage you to submit questions if you will. If you're having audio or visual problems, call our office at 800-700-0089, 800-700-0089. So we wanted to start by just covering some of the dynamic forces that are going on in the market today that have influence. So, of course, rising interest rates is a big part of the dynamic in the conversation. And as Corinne alluded to, we do know that our Federal Reserve Bank did decide to raise interest rates 1/4 point today. That was announced at 11 a.m. Pacific time, 2 o'clock on the East Coast. So that is a fait accompli. And let me just say at the outset that this is a bullish action, and the market took it that way. We've had three good up days, including today, with a very strong improving market. So it is something to celebrate. It's happening because the U.S. economy is improving. We are putting it's in a way it's an endpoint to the Great Recession. Another sign that we're beyond that, and we're moving ahead. On the slide here, you'll see an indicator that since the 1980s, there's been 5 cycles in which the Fed raised interest rates. And in every one of those cycles, economic growth remained steady or accelerated. Looking at a chart of the U.S. market, that's also true that even 12 months out after the first increase, the U.S. market's been able to increase, grow, and improve. So this is a bullish indicator. History indicates a good outcome. Leading up to this first move in almost 10 years, the Fed, Janet Yellen, and other governors have been really touting a dovish tightening schedule, meaning they'll be very measured and gradual, that they're going to see what the effect is of this first rate increase before they assume that they're going to do more. So that's very positive as well. And this is the beginning of normalizing our interest rate environment. And I always think moving from the abnormal to normal is a good thing, so that's positive as well. One of the things that we've been watching is that higher interest rates will certainly benefit the financial sector, banks, brokerage houses, insurance companies, and we've already seen movement in that direction, and we're starting to allocate towards that sector in the funds that we choose. One sort of uncertainty is that the United States, because we have recovered faster than any other developed economy after the Great Recession, we're now diverging from the central banks in Europe and Asia in that they're continuing to cut interest rates, even go negative on interest rates in Europe, and they're also expanding or maintaining quantitative easing. We're going in just the opposite direction. So in a way that represents an unknown risk, one of the positive things bringing us up to this point is that central banks around the world have been pretty unified going in the same direction. So that's just a bit of an unknown. The next dynamic is about oil. Certainly weak oil. It's a very dynamic situation. We wrote up these slides over the weekend, and I think that first point here, that oil's at a 7-year low, that's already changed. I'm not exactly sure where it is today, but I think Monday or Tuesday it was at an 11-year low, so very hard to keep up with the dynamics there. And you can see in the second point that the change in the price of oil and natural gas has been very dramatic, at 63% drop and a 52% drop. One of the kind of the assumptions was that with all American households saving on gasoline and heating oil, that this would increase consumer spending, that with more money in their pockets, that would certainly help the economy. The results on that have been a bit mixed. It hasn't been as strong as we might have expected, although the consumer sector, Corinne will talk about that in a minute, has also shown signs of strength. But it's part of the oil story that hasn't quite played out to the degree that was expected. It seems that households have used that extra money to increase their savings or pay down debt. The other aspect of the whole oil drop in prices is that it's a very disruptive situation for part of the business and economic sector that's very important, energy. So I think that has the financial markets disturbed and perturbed about what the fallout's going to be. The energy field affects a lot of other industries like steel. So this drama is certainly creating some negative aspects to our situation. Loan defaults are certainly on the rise with energy companies. U.S. companies are still producing to pay debt. If without the debt, they might cut back on their production because the price is so low, but that continues to go on. And the situation with OPEC is very interesting. In my lifetime, OPEC has always strived to prop up the price of oil, and the theory is that now they're really committed to driving down the price, hoping to discourage production in the United States, maybe put a lot of these energy companies out of business, which has begun. So it's a very different purpose and activity on the part of OPEC. The other dynamic is certainly the strong dollar. The U.S. dollar's up 12% versus the euro in this year. This is going to hurt large multinational companies, U.S. companies, because they have to sell their goods and services overseas. And our goods and services in Europe and Asia are more expensive than they used to be before the value of the dollar went up. One of the things that we're watching is that the small cap companies in the United States should benefit from this dynamic, in that they don't, as a general rule, they don't have as much business overseas. They're not dependent on overseas consumption or for their sales activities. So the strong dollar is good for the United States in terms of, we can buy goods and services from outside the country at a better price because of the strong dollar, but our goods and services are not as competitive to export overseas. I think the positive aspects of the strong dollar dynamic is that the United States is the best capital market in the world, which is why the dollar's strong, which is why our central bank is beginning to normalize interest rates. And in that position of strength, it does attract capital. So that could also be a bullish indicator in some respects. about a month or so ago, there was an article in the Wall Street Journal outlining where some different sectors of our economy and market, how much they depend on international sales, or how much are they going to be affected by the strong dollar. So on this chart, it shows that consumer staples and consumer discretionary as two separate sectors will be in a beneficial role because they're not as dependent on selling overseas as our materials, energy, and technology sectors. So consumer discretionary has been one of our favorite sectors to invest in this year, and Corinne will be talking a little bit more about that in just a minute. Finally, the American job machine is entering its sixth straight year of producing at least 2 million new positions annually. This kind of forceful production in new jobs, we haven't seen this pattern for this length of time since the 1990s. So it is a bullish indicator. It's dramatic. It's an example of American resiliency, and I think it's going to behave like compound interest, where new jobs beget new jobs, because when you have people working and earning income, they have money to spend and other businesses to support. So I'm going to ask Corinne to jump in here now and talk about some of the markets.
Thank you, Jim. I'd like to start by reviewing the year-to-date performance of the S&P 500 index. That index tracks the largest 500 companies in the United States based on market capitalization. As you can see in looking at the slide here, as of last Friday, the S&P was down negative 2.3% year-to-date. That's just from a price perspective. Including dividends, however, the index as of Friday was flat. As many of you know, this data is a bit stale, and we've had 3 big up days. So even from a price return perspective, we're now in positive territory. So we're happy to see that. But really, we want to highlight the importance of dividends. Again, as of Friday, the index was down from a price perspective, including dividends, however, relatively flat. The year started out fairly calm until July and August, that is, when the market pulled back by 12%. That is the largest correction we have seen since 2011. In that year, markets corrected or declined by 19%. That was in the summer of 2011. But by the end of the year, the S&P ended in positive territory, and that's certainly what we are hoping for this year. We're hoping for that same outcome, and as it stands today, we are again in positive territory. Jim alluded to this earlier in the presentation, but here are the sectors within the S&P 500 and their varying performance year to date. Leading the way, as you can see, is the consumer discretionary sector. It is up. As of Friday, it was up 7.8% and has been one of our favorite sectors this year. We've been over allocated there, along with technology, technology, healthcare, and we're just moving into financials, or rather just began probably 3 months ago. We're seeing some near-term positive momentum and expect with the increase in the interest rate that this sector, financials, will continue to benefit. We've received questions in the past about consumer discretionary, that sector specifically, and what types of companies are in that sector. As the name would imply, this sector aligns with consumers and their discretionary or extra money that they have. And really the question is, what do these individuals do with that excess cash? In general, they shop, they fix their houses, they travel. And so stocks or companies that are aligned with those behaviors are going to benefit. Some examples are Amazon, Priceline, Nike, Starbucks. I could go on and on, but that just gives you an idea as to what companies and types of stocks can be found in that sector. Final point on this slide is the benefit of momentum, and that we are able to over allocate to the two areas of the market that are doing well, including consumer discretionary, technology, and healthcare, and avoid areas of the market that are not performing well, specifically energy, utilities, and materials. And that has really, we benefited from being able to over allocate or under allocate in that way. This next slide details different factors that we look at every month in our investment committee meeting. We look at these factors to help us determine or better determine where we are in the market cycle. On the negative side of the equation, as many of you know, stocks in the US are quite expensive right now. Depending on which price to earnings ratio you look to, the S&P 500 is anywhere from 13 to 28% overvalued. This is important to be aware of, but not a factor that we would encourage you to make a strategy decision on. The reason is price to earnings ratios are a poor predictor of near-term performance. They're a better predictor of long-term performance. Because really stocks can stay elevated for years at a time, and we saw this in the 90s. In terms of positive sides of the equation, Jim spoke to monetary policy, and even with the Fed's decision to raise rates today, rates will continue to be at historical lows for some time. In our earlier meeting, Jim mentioned that the average rate for interest rates is anywhere from 3.5% to 4%. So we are a ways away from that average. The economy also not growing by leaps and bounds, but certainly is stable and growing. And so we are keeping that in the positive category for now. As you can see, there are many factors in the neutral category, the first being investor sentiment, which includes both institutional and retail sentiment. We would like to align with other institutional investors, and those, the analysts that we follow and the newsletters that we read are currently cautiously bullish. So we think that's a good sign. We share that same sentiment. In terms of retail sentiment, that's a contrarian indicator. So the idea there is to not align with what individual investors are doing. And after the October rally, there was extreme exuberance in the marketplace based on individual investor sentiment. On to credit spreads. Though the spread between high yield bonds and safer issues like treasuries is wide, it's not quite wide enough for us to move credit spreads to the negative category. That said, we are watching this indicator very closely. Final two indicators, we have momentum signals. The question there is risk being rewarded? And based on what we're seeing in our investment committee and our different funds that we're tracking, yes, so far this year in general, the riskier classes and investments are doing better. This category or factor remains in the neutral category, however, because both cyclical and defensive sectors are performing well. That's not something we generally see. Finally, market breadth. There are a number of technical measures that we look at, like how many stocks are above their 50-day moving average. Some of these technical measures are positive, others are not. In conclusion, we look at these factors each and every month and take a chance to determine where the market is. In terms of foreign stocks, we wanted to show you this chart to compare where international stocks are in comparison to domestic. Here's the chart tracking the performance of the MSCI EAFE, which stands for the Morgan Stanley Country Index, and it tracks Europe, Australia, and the Far East. As of market close on Friday, this index was down negative 4.8%. and had surpassed the low that the domestic market set on August 24th. With all that said, the international markets are 25% cheaper than stocks in the US. And as I mentioned earlier, this valuations, that is, it's a poor predictor of near-term performance, but a strong predictor of what's to come. And so we do think the day will come when foreign markets will outperform domestic, and at that point we'll be ready to allocate to foreign stocks. Finally, quantitative easing measures in Europe and Japan should really help those markets grow in the years to come. Jim, could you talk about the individual regions we're seeing and their performances?
Thanks, Corinne. So as Corinne and I have been indicating from what we've looked at so far in this presentation, we are guardedly optimistic. We do think the bull market will continue next year, but we wanted to take a look at what the world has presented us with this year. Not a lot for us to work with. You'll see all these regions are negative with the exception of Japan and Russia. We don't think Russia is really a viable opportunity. Many of the experts that we listen to advise that nobody should invest in Russia unless you understand the Russian mafia. So that's not a key player in our universe, but Japan is, and we've been experiencing some profit from Japan throughout this year, and we're certainly going to be watching this closely in terms of there might be opportunities in Europe and continuing in Japan with the quantitative easing, and as Corinne indicated, Europe certainly represents a good value in terms of what we have to pay for earnings. We wanted to also address the bond market, the fixed income markets. As you can see here, that the 10-year Treasury, although it did return just over 2% on a total return basis, it's been pretty well. It's moved around a lot, but it hasn't moved a tremendous amount from the beginning of the year to where we are now. We don't think this beginning of the interest rate increases is going to be terrible for the stock market or the bond market. We actually think it's going to help. The uncertainty around when the Fed would move was creating more of a drag than the first move itself. Now, what they do from here is going to be very important. The U.S. Treasury, the 10-year Treasury market, being better than the Barclays U.S. aggregate bond market, which includes a lot of corporate issues and mortgage-backed securities, just shows that quality was very important this year in the bond market, as the 10-year Treasury, being one of the safest investments in the world, compared to some diversified corporate and mortgage securities, the return was better. So just to conclude this part before we end with some tips about year-end tax activity, our expectations for next year are modest. We do think the stock markets will present some positive return. It's really impossible to predict the future, but our analysis shows that we would modestly expect a 4 to 6% nominal return from stock market investments. The second point here, as theory of relativity, I think relative strength is always a factor. Where is money going to go to earn a return? With interest rates still low, just starting to come off the zero level, we don't think the bond market, although it's a good source of stability, is going to offer a lot of competition. And with the strength of the U.S. dollar and the U.S. economy, we think the U.S. economy is going to attract capital. one of the rules of you always want to invest where currency is strong, and there's no place stronger than the United States. So we think foreign capital is going to continue to come in, and that will help. Final point here is that we at Bell Investment Advisors, we believe all portfolio design and risk allocation should be sourced out of a financial plan. So we do encourage everybody to engage in financial planning so that your portfolio can be grounded in your particular situation. What are your needs for cash flow? What are your living expenses? What is the optimal portfolio design to ensure that you can live a good life and not run out of money? That's what financial planning produces. So we do think every investment strategy should be sourced out of a comprehensive financial plan, and that's what we do here at Bell Investment Advisors. So I'm going to ask Corinne to take care of some last-minute tax tips for us. Corinne?
You bet. So I'd like to discuss something we are being very proactive with this year, and that is tax loss harvesting. That strategy involves selling positions at a loss to either offset gains that have already been realized from other positions so far in the calendar year. It also helps to offset capital gains distributions that will be paid out by different funds at the end of the year. One thing we'd like to remind you of, or let you know to be aware of if you are harvesting losses on your own, is the wash sale rule. And that essentially says you cannot buy the same fund back within 30 days, or even a fund that's substantially similar to the one that you just sold at a loss. If you do, then your cost basis will be adjusted to offset the loss. Another tip is about charitable giving, and if you are considering year-end giving, we'd like to remind you, you may donate appreciated shares. It has the dual benefit of is you're able to deduct the market value of those donated shares and also avoid the capital gains tax that you would otherwise pay if you were to sell the holding. Another tip or reminder is if you do utilize this strategy, please make sure it is a fund that you've held for at least 1 year. Finally, I'd like to touch on Roth IRA conversions. There are no longer income limits on this strategy. Those were removed in 2010. And so the idea is you're able to move or convert money that currently is in a traditional IRA to a Roth IRA. You will owe ordinary income tax on the conversion amount. However, going forward, that money is never taxed again. It's not taxed while it's in the Roth account and growing, and it's not taxed when you withdraw or tap the Roth. Generally, this strategy is beneficial to younger investors and investors in lower tax brackets. It's beneficial to younger investors because they have the time horizon to make this strategy work, and investors in lower tax brackets don't have to pay substantial tax on the money that's converted. Again, a reminder, the deadline for this strategy is December 31st. And we'd really encourage anyone who's considering this strategy to speak with your tax advisor, as it is rather complex and is not an ideal strategy for every person out there.
Thanks, Corinne. Corinne and I want to thank you for joining us today. We're at the 30-minute mark right now. So we do encourage you to contact us if you have questions. For those of you who did submit questions during this presentation, we'll make sure to get back to you to get those answers for us. We appreciate you keeping in contact with us, and we have many ways that you can do that. I do want to remind you that on our website at bellinvest.com we have a comprehensive library of various topics. We did record this session today, and it will be posted on our website next week. We hope you'll follow us and stay in touch with what we'll be doing in terms of webinars next year. Our first scheduled webinar will be in February. That's for clients only, when we'll be doing an investment committee update. So again, happy holidays and happy new year. And please stay in touch. There's many ways to connect with us, as you can see on this chart. And we look forward to having more conversations with you in 2016.